Today we want to set the stage and talk about how to build wealth without being a landlord. Most people are really interested in real estate investing. This is an episode for those who are making a high income.
I studied finance, economics. I got a job working for an investment firm in Boston. That's where I went to school and stayed there. 15, 16, I started to buy properties myself. The value drops and you got to put in money. It's very dangerous.
A syndication is essentially allowing multiple investors to pool their money together to take down a big deal. Really what we're doing is we're looking for projects or properties that are underperforming.
To tell everybody that you run into what you do. If you look at the 2008 financial crisis, one of the markets we invest in,
having operators, general partners on the deal, where they're doing all the active work versus being a passive investor, somebody that says, hey, I have $50,000 or I have $100,000. I want to contribute just my capital. If I keep my buy box somewhat narrow, and I'm buying right now in the Northeast at 5 to 50 units.
To another episode of the Wealth Juice podcast. As always, it's your boys Ryan and Corey here with another episode. Today we want to set the stage and talk about how to build wealth without being a landlord. Most people are really interested in real estate investing, but they lack the time, energy, and resources to get started. And this is an episode for those who are making a high income and they have some cash on the sidelines and they want to, deploy that into income producing assets. So what we want to do today is kind of showcase that you can actually get into real estate without the late night tenant calls, fixing toilets, giving up your weekends. And without further ado, we decided to bring on one of our good friends and partners, Shawn Winslow, who is a master in the multifamily syndication space, to have a conversation with us about this, how to kind of run the ship, and then really how to dive into this world if you fall into some of the buckets that I mentioned before. So welcome back to the show, Shawn. Thanks for being here.
Master, that's high praise. I don't know about that, but I'll try to live up to it, guys. But Ryan, Corey, thanks for having me back on. Always a pleasure.
Yeah, it's our honor, man. So we're excited to have a conversation with you today. So I really want to talk through your journey into real estate. You have been on the podcast years ago. I think 2022 was the last time we had you on the show. But I want you to take us back to pre-real estate, right out of college, what you studied, what you got into, and then really the transition to becoming an entrepreneur and a real estate investor.
So straight out of college, 2012. So a little while ago. It's crazy how time flies. I studied finance, economics, and I got a job working for an investment firm in Boston. That's where I went to school and stayed there. That's what I thought I wanted to do, quote unquote, Wall Street, making money off of other people's money. That's where I thought I was headed, right? Like most people, do well in college, get a good job, and that's your life for the next 40 plus years, right? The golden handcuffs. So that was the journey, man. That's where I thought the future was for Shawn. And there's nothing wrong with that path. It just ended up not being for me.
I think what we should do here is Ryan mentioned having you on in 2022. And it's funny because when we had you on in 2022, we ended up getting together, Zooms, putting our brains together for another year until we actually partnered together. So you had bought multiple properties in Georgia, some in your backyard. We always talk about our 18 unit in New Hampshire and our 10 unit in Vermont. And you're the guy that we've bought these projects with, along with bringing on LPs. Prior to us, just tell us about your portfolio, how it unfolded. You were buying properties in the Southeast. You went back up to doing them at home. Give us a little background of where you're at with your portfolio, and then we'll kind of blend the brands, if you will.
Yeah, of course. So I was working in finance still in Boston, and I just like most people were conditioned is if you want to make a change or learn something new, you got to go to school, right, and learn. And so, that was before I knew of the YouTube University, which most people are accustomed to now. So I thought I had to go back to school. So I took a night program in Boston at one of the universities there for real estate finance. And I thought my path was to go into kind of, the corporate side of private equity. So work for a private equity firm on the real estate side. Because there's a bunch of those in Boston. And so that was the plan. And while I was there, one of the other students that was there he was trying to get out of that side of the syndication space into more like traditional corporate finance and real estate. And I was like, what is syndication? I hadn't heard of the term back then. That was probably 2015, 16. And he told me what it was. You can go buy bigger deals that you probably wouldn't be able to buy with your own money, and you pull together a group of investors and their capital, and you go buy a larger property and you operate it as a group. I was like, in my head, I was like, man, why are you leaving that? That sounds like the dream. That's what I want to do. So I dug deeper into the rabbit hole, and as I was learning, I started to buy properties myself because that's what I wanted to do. And I realized I don't want to go down the corporate route. Like, I like real estate, and I liked it for a reason. I like the tangible side of it. I like the fact that it's, in my opinion, the best investment that you can safely, obviously I'll put safely in quotes because some people don't do it correctly, but safely use leverage to invest. Whereas the stock market, you can use leverage. It's called margin. You get a margin account, but that's not safe, especially if you don't know what you're doing, right? Yes, stocks are liquid, and that's one of the benefits, but that's one of the drawbacks when it comes to using leverage, because it's so volatile that you can get what's called margin when, the value drops and you got to put in money. It's very dangerous. So to me, that's one of the benefits that if you do it right, you buy right, fix debt over a long period of time is a safe way to use leverage. So you can use leverage to buy more than you could with just cash, right? I like it for inflationary benefits. There's something called debt debasement. And I don't want to get too in the weeds. We can talk about this stuff later. Tax benefits. So I knew I wanted to be there. And I also loved the fact that when I was in finance, I would go to meetings with clients. That could be at the golf course, could be at a sporting event, stuff like that. And the other people I would see at those events would be people like me on the sales side, or people in real estate, or business owners. And more often than not, it was real estate people. They had the money to do that. They had the flexibility to do it. And I knew that's what I wanted to do. So what I started doing is just buying small multis throughout southern New Hampshire while I was still working in finance. And then it got to a point where I had to make a decision. And that decision was to stay in finance and maybe scale back the multifamily side, because I just didn't have the time to balance both of them. And it was also kind of a conflict of interest, because the next step was to go to raise money to do larger deals. Well, I couldn't do that while being, licensed by FINRA and raising money on my day job for what I did there. So had to make a decision. And ultimately, I think we all know where that went. I picked the real estate side, and through this new world of, virtually meeting people, that's how Corey, Ryan, and myself came to be.
Yeah, man. This is great, because at its core, when people talk about using other people's money for real estate, like there's a number of ways you can do it. But one of the strategies is, hey, I'm really good at going and finding these deals, or I'm really good at bringing the money because I know people that have money, and I am able to market the deal and underwrite the deal and manage the property manager. And our position here is kind of perfect, because Ryan and I are good at marketing. We're good at investor relations. We know how to underwrite deals, and we are meeting with our property manager, where you're managing a lot of the construction side and you're managing like tenant turnover. So like it melds perfectly. But at its core, having operators, general partners on the deal, where they're doing all the active work, versus being a passive investor, somebody that says, hey, I have $50,000 or I have $100,000. I want to contribute just my capital, just leverage my capital, and I have no downside risk if the deal goes bad outside of the capital that I put in. And that's where the GP, generally actively participating in the LP, come in. And that, I think that we have created this cool partnership where it's like, you're the reason that we're investing in New England, and Rye's from New England. And it's kind of like he's back home, and our portfolio has the 18 unit, the 10 unit, and now it's growing even more. We're looking at deals. Ideally, we're trying to buy one a quarter. I think we're at like a one a year pace right now, but we're trying to ramp that up. So I'm going to talk to you about, I know this is kind of where you live, and that's why Ryan and I are so excited about it, because it's like Shawn's boots on the ground here. Like, so talk to us about what you look for in New England.
Didn't want to invest in Massachusetts because that's very not landlord friendly. It's very resident tenant friendly. Plus back then, and you can make this argument at any stage of the cycle, but it was you're paying a premium for what you were getting. So New Hampshire is where I focused. And now looking back, or now that I know more and why I still invest here, there's a multitude of factors. One, there probably isn't as much competition as, it's still very competitive, don't get me wrong, but as some of the, Sunbelt states, because everyone and their mother that wants to invest here is Sunbelt states, and they want to go there. You know, the Texases, the Floridas, maybe not Florida as much anymore, what's going on there, but Georgia, the Carolinas, like everyone, Tennessee, everyone wants to be there, and for a good reason. But there's not as much competition because people, I think, get deterred by the Northeast. But the Northeast is super resilient. If you look at the 2008 financial crisis, one of the markets we invest in, I was in the New York Times back then, that it was the best performing town in all of America during the 2008 financial crisis. Has to do with the makeup of the area. There's something called a micropolitan, which is a term that means an area of surrounding towns that make up one economy, right? So like a Boston is one city, right? But it's one economy. But in smaller tertiary and secondary markets, you'll get like a economy similar to Boston. I'm not saying in size, but you know how it's like one ecosystem, but it's made up of smaller towns. And in one of the areas we invest in, New Hampshire, it's the top, from an economic standpoint, it's the top micropolitan in the country out of 500 micropolitans. So it's the fact that it's resilient. We look for areas, what we call eds and meds, so higher education and medical centers. When you get those combined together, it helps really build a resilient economy, because they're two institutions that are just very resilient, and are, you know, if it's a good school and a good medical institution, it's gonna beat the test of time. It just is. There's a lot of money backing them, a lot of demand backing. So those are the things we look for. We also look for, you know, like everyone else, rising, you know, population, rising job growth, rising medium house values, and we just want to see a healthy economy.
Yeah, I want to jump in here really quick just to catch people up, because I think for some people this might be the first time that they're hearing about real estate syndications, and they're like, okay, you guys said you're going to be talking about how to build wealth in real estate without actually becoming a landlord yourself. Basically what is happening at its core here is, instead of one person buying an entire apartment building, a syndication is essentially allowing multiple investors to pool their money together to take down a big deal. The GPs, which are the general partners, which Ryan, Corey, Shawn, we run and operate the deal on a day-to-day basis. And that starts all the way back to finding the deal, securing financing, executing the business plan, basically running the day-to-day. Then the limited partners are the passive partners that provide the capital to take down the deal. And then we share in the profits. Just to give a high-level overview for people that are first-timers listening into this, and they're like, okay, this makes sense. So we're really talking about, hey, when you're at this stage in your career where you have some cash on the sidelines, you want to invest this into an income producing asset that's scarce, but you don't have the time to manage it on the day to day. This is something, or specifically a lane, that you might look into. And for us, why we target value add multifamilies is, in New England specifically, is for some of the reasons that Shawn mentioned. But really what we're doing is we're looking for projects or properties that are underperforming due to poor management, deferred maintenance, or their rates right now that they're charging are below market rents. In the long run, it's typically a 5 to 7 year plan. We either refinance the property for not only a better rate, but to pull some capital out, or we sell the property. And that's how everybody gets paid back. And that's the vehicle that we're talking about, and the process for doing this. And then, you know, for us specifically, Corey mentioned, like, Shawn, your boots on the ground, New England. You know, I grew up there. We did a ton of projects, you know, single families, duplexes, triplexes, Corey and I. And we wanted to get into the bigger space. And typically what it is to find people that you can find complementary skill sets. And what we realized is you were lacking in one spot, you were amazing in certain areas, and then we were lacking in the exact opposite and great in the opposite. So it's kind of like you find the two perfect mediums to find a partnership. And I just wanted to set the stage there. We can dive in a little bit more on New Hampshire and Vermont. Two recent projects I kind of want to dive into is what we've been the last like 2 to 3 years been working on. The first one was the 18 unit we took down in Manchester, New Hampshire, which is right outside of Southern New Hampshire University. And really the business plan here was to acquire an asset that was underperforming for a number of reasons. We went in and essentially redid all 18 units, put in new floors, countertops, fixtures, all of the above. But the business plan was to remove the current tenants that were in there that were not paying on time and essentially transition everything over to Section 8. And with doing this, we were able to charge higher rent, but also get the guaranteed government checks on a monthly basis. I know a lot of people are scared of Section 8, but I did want to dive in and like really explain this is a solid business model and recession proof for those who are looking to get into bigger type deals. Shawn, I don't know if you want to kind of dive into any more of the deal specifically, but I wanted to give a high level overview because this deal has been a home run for us so far, and it's really crushing.
Yeah. And that was not all of our deals are Section 8. That just so happened to be, we saw an imbalance in the market, or I guess arbitrage, where at the time there was such a need for Section 8 housing that what you could get from that voucher was actually higher than what market rent for, a Class C property was trading at the time, or what was getting at the time. So we saw a great opportunity, and it's been a solid deal that I know we're excited about. Hopefully our investors are, because we've been overperforming our budget, and it's been a solid deal where it was referred to us by our property manager. He had an investor that was trying to get out of the deal for one reason or another. I think it was to move some cash into another deal. And that's one of the things I just emphasize to anyone who wants to do anything in life, whether it's investing in real estate or maybe it's another business side hustle, is to tell everybody that you run into what you do and what you're looking for. And so, for example, anytime I get on the phone with my property manager after we're done discussing our properties, I always say, you see anything? I'm looking for deals. I'm trying to buy deals. And that day he happened to say, actually, I just got an 18 unit sent over to me literally right before we got on a call. I'm like, well, shoot it over. And so that's how we found that one. And then Ryan, Corey, and myself partnered up. We all raised some capital from our investors, put it into the deal, and now we're operating it. And it was, like Ryan said, a value add play where we came in, renovated all the units. We kept the tenants that were paying, that were a great part of the apartment community. And the ones that were not paying, we obviously had to find new, I like to call, residents that made the apartment community even better. And the cool thing about doing it is, obviously we're doing it for a return for our investors. It's a business, but it's really cool when the residents themselves, the ones that stay after, thank you for doing what you did, because you obviously improve the quality of the unit, but you also just improve the quality of their life, because I like to say you're cleaning up the bad stuff, right? And we even had local law enforcement thank us, because we made that area cleaner, safer, not as much loitering. We put lights on the back, security cameras. It just makes it feel like a safer spot when you're walking by. And to me, that's just as rewarding, is improving the lives of other people. And that we got to put Section 8, affordable housing in is even better, right? Because that's a huge need in this area. That goes back to another reason we like investing in New Hampshire and parts of the Northeast, is because there's such a supply and demand imbalance. There's just not enough supply for the demand. New Hampshire itself needs 50,000 additional housing units by 2030, and they're nowhere near on pace to hit that. And in one of the markets we specifically focus on, 10,000 is needed. And again, it's just nowhere on pace to hit that.
Yeah, dude, it's a killer deal, and it's something that Corey and I were really excited about. And this is one of the larger projects that we had taken down, and it's just been amazing seeing real estate and the benefits it can impact a community, rather than just the numbers on a P&L sheet, right? The next deal I want to talk about is another project we actually acquired at the beginning of this year. It's a 10 unit, so it's a 6 unit on one side of the street and a 4 unit on the other side of the street in Queechee, Vermont. And this one, different business plan, but is basically a turnkey property, just needed really some furnishing and a little bit of an upkeep. But one of the sexy parts about this deal, again, is it was from a referral. Real estate, what I want to highlight is a relationship game. And just to double click on what you said before, letting everyone know what you are doing, your business plan, and what you are hoping to accomplish, it allows the universe to feed you with that. And that's exactly what happened for this deal. Really, like the underlying theme of this project, Section 8 was for the 18 unit, but for this one, what we were really doing is, because it's really close to Dartmouth Health and Dartmouth College, is we were targeting traveling nurses and grad students that receive stipends. And what can happen is you can increase what you charge for rent, because they're already getting stipends to essentially pay for their housing. And you can do this on a short-term basis. We were looking to transition the business plan from 12-month long-term leases to 6-month short-term leases, or I should say mid-term leases. But once again, I'll let you, I don't want to spoil this, but it's just funny that just to prove how in demand properties and housing like this is in the area, we were able to charge a larger amount on a 12-month lease. So can you talk to us a little bit about the deal, how it came to be and putting the business plan together?
Yeah, completely different deal than the 18 unit, right? This is a different, obviously, area, neighborhood. The household income is a lot higher in this, in this kind of area. It's around 90,000. So a lot higher household income. It's in a neighborhood that's part of an association that has country club, 2 award-winning 18-hole golf courses, actually has a small ski hill, what they call a lake, but it's essentially a pond with a beach, tennis, paddle, pickleball courts, has all this, right? And so it's right in the heart of this community, right on the main street. And in this part of the world or the country, this is not somewhere where you normally can walk to any type of amenity, but where this is located, you can actually walk. So you can walk to, there's walking trails, the local post office, bakery, restaurant, bar. You can actually walk. It's just a solid location. And again, it caters to, unlike the 18 unit, it caters to more of a working A-class resident. It's still an older property, but it caters to that individual. And to Ryan's point, yes, our original plan was to do a mix of long-term and mid-term units. So we're going to furnish some, put it on Furnish Finder, get either traveling nurses, other local workers that need more of a short-term basis that will pay a premium for that shorter term and for furnished living. But to Ryan's point, the supply and demand is just crazy here. There's just not enough supply for the demand that is here. And we were able to get rent that was encroaching on what we would get from the midterm. And so why would we do midterm? Or one, we got to furnish it, but then we also got to pay for the utilities. So the heating, electricity, you even got to put in Wi-Fi because they definitely need Wi-Fi. So at that point, it just didn't make sense to go that route, which, is fine if we're still beating our budget. So it's not like we're below our pro forma. And that just highlights that you have to be flexible, right? You can't be so fixated on the business plan, or I should say, you got to adapt, right? And that's not to say in a year or two, maybe some things will change and we'll go that midterm route. It definitely could, but it's a different deal. And we're just looking for, and I can get into what we look for, but we're just looking for, solid deals with strong risk-adjusted returns and that are multifamily. Typically in this area, you're going to be looking for 10 to 50 units, 10 to 30 units. There's just not a lot of big multifamily apartments in New Hampshire. It's just really in most of New England. It's just really not a thing unless you get into Boston, Portland, Providence, that area. You'll definitely get some bigger ones, but most of these secondary and tertiary markets are not going to be big. So it's probably a $1 to $5 million purchase price.
I want to just go through really quick here just to conceptualize this for people too who are probably driving, listening to the show. But how the process works from start to finish is, finding the deal is the first thing, right? We look for underperforming assets. We mentioned in New Hampshire and Vermont. These are traditionally through broker relationships, the off-market outreach through relationships, and local connections. Really, that's the benefit of having you boots on the ground up there, Shawn, which is amazing.
Yeah.
The next step is analyzing the numbers, right? We go through a very conservative underwriting process with multiple scenarios where we stress test the deal to make sure the numbers we're not overinflating. So that way, it's funny, people should see our Excel files here, but there's 5 different stress tests that we go through, and we really go through the most conservative underwriting to make sure that, hey, regardless of what happens to this property, if we do end up buying this, it hits those conservative numbers and it potentially gives us a big upside. And then we go through the due diligence process, right? So inspections, financial audits, lease reviews, and then a contractor bid to kind of confirm our business plan to make sure we're in line with what we're looking for. Then it comes to the financing, right? So we secure loans and bring in equity from the passive investors at that stage, right? So, if we do get a loan, then it's time to say, okay, who wants to passively invest into this deal with us? We go to our VIP list, right, of investors that have taken down deals with us. And, we're open to taking on new people depending on, whether they're sophisticated investors or accredited investors, right? And we partner up and we take down the deal. And so then from there, once the deal's funded, that's up to all of us, meaning Shawn, Ryan, and Corey, to execute the business plan, renovations, management upgrades, rent optimization, expense control, all of the above, right? And then we distribute cash flow on a quarterly basis. At least we have for the majority of our projects. Whereas, the passive investors that, put up the capital to fund the deal, they then receive their quarterly distributions of cash flow, as one of the major real estate benefits. And then after the 5 to 7 year period, sometimes it's 3 years. It just depends on where the market is. That's where we go for the refinance or the sale. So, right, the property has then stabilized and we look for, hey, is this an optimal time to either refi this or to pull capital out or to sell the project as a whole, where if we don't think it's going to appreciate too much more over time, we kind of see the value kind of diminishing to where it more so if we've optimized to the point where we're saying, hey, we put the stake in the ground, let's get out of this one. And then the investors share not only the cash flow and the appreciation, but then the equity that's built up, upon the sale. So it's amazing. And the tax benefits are crazy. Corey and I were talking about this. I believe it was the 18 unit. There was a massive, from doing a cost segregation study and then some of the tax laws that had changed, we got to write off a ton in taxes for that year, which was amazing because you really see why people, when they get up to the upper echelon of this game, start making a high income, they buy real estate specifically for the tax benefits, specifically to offset their earnings, I should say. So my point is real estate has a ton of benefits. And this specifically is the way Corey and I are buying properties as we move forward. I think just to give a little personal anecdote, we're in the small to mid-size multifamily. You mentioned like the 10 to 50 units. That's our wheelhouse now, right? And like that's how we're continually looking at deals. And I think, we can get into a bunch of different things, but I want to just talk about Shawn, you almost alluded to this a little bit earlier in the podcast, but like we believe in multifamily so much so that it's like it has outperformed the S&P 500 historically over time. And like, I'm not saying don't have your money invested in stocks at all, but the real estate benefits, if people have been listening to our podcast, you've probably heard us say these time and time again, but if you're new, I just want to like reinforce this, why real estate is so sexy. When you buy stock, you're typically trying to buy it low and sell it high, right? To make the delta in the middle as your profit. With real estate, there's so many other benefits. We talk about 7 of them over time. What I want to hit on is cash flow. It's, regular income from the rent. So basically like the delta between your income and your expenses, there's your cash flow. Leverage, you can control 100% of an asset with only 25 to 30% down. Appreciation, the properties rise over time. And as we increase the NOI on the property, I already talked about the tax advantages. It's insane. But stability is one of the biggest things, is like having something in the ground that you can manipulate and control and force appreciate over time is something where I feel so much more confident than just throwing my money into the market and hoping that the shares in the business that I bought go up. To be able to have control of this is amazing. And then the amortization, where the tenants are paying down our mortgage every month and you're slowly building up that equity over time. There's nothing like real estate. So I don't know if I missed anything there, Shawn, but you kind of talked about what we look for and the benefits of it. Anything you want to touch on?
Yeah, I can add on to that. So I came from the stock world, let's just call it, right? I worked for a firm that had ETFs, mutual funds, smart beta products, SMAs. And so I come from that background, and I could be clickbaity here, or I could be, get the clip for the socials and be like, stocks suck, go real estate, go multifamily, but that's just not true. I made a crap ton of money off NVIDIA, Tesla. There's some oil and gas plays, recently gold plays. Like, I would be lying if I said that. However, I will say this, to Ryan's point, it is very volatile. And if you don't know what you're doing, you can get your butt handed to you real quick. There's something that we always looked at when I was in finance, and that's risk adjusted return, specifically a metric called the Sharpe ratio. And I still look at that to this day. And that's just measuring the risk you take for what the return or the reward you're going to get is. Essentially, is it worth the risk you're taking? Is it worth it for the potential return? So if you look at that metric when it comes to multifamily as a whole over the last 30 years, and when you look at it at the S&P 500 over the last 30 years, it paints a story. For those of you that like to know what the Sharpe ratio is, it's the market return over a given period minus the risk-free rate. So it's calculating the excess you're getting in return, or the alpha over the risk-free rate, divided by the standard deviation of that investment. So it's going to give you a ratio. Anything below 1 is not great. 1 and above is good, and anything above 2 is great. And so the S&P 500 over those 30 years was about 0.5. Not great. So it's essentially saying you might have gotten a good return, but it wasn't necessarily good justifying the risk you took. Whereas multifamily was at 1, meaning so it was good. So the return was good, justifying the risk you took. And I think that's very important for anyone's portfolio. The way I look at it, and I'll be transparent, 90% of my wealth in my portfolio is multifamily. And it's for a reason, right? One, I know how to control it. And I've mentioned this before, right? It's the best way that I know to safely use leverage, right? Now, like I mentioned earlier, you can easily not use it well, and it cannot be safe. But if you're buying at the right price, at a discount to the market, fixed rate over long term, if you know how to operate, things should not go wrong. The second big thing I love is a term called debt debasement, which has to do with inflation. So you're buying, if you're buying with fixed debt, you're buying in today's nominal dollars, right? You're not buying in inflationary dollars. You're buying in today's nominal dollars. And if you're buying with debt, it's a substantial amount of debt, 50% plus leverage. That's going to be your biggest expense on that property. So just think about that. Your biggest expense on the property is staying fixed over a long period of time, where your rents on average are going to grow 3 to 5% per year.
Yep.
Over that same time period where your biggest expense is staying fixed. It's exponentially up, right? That's why people say it's an inflation hedge.
Yep.
Now you can get, some people might argue, well, you're going to get, insurance up, taxes up, 100%. But over the long term, that's why it's time in the market and not timing the market. Over the long run, you're going to outpace any of the expense growth, especially when your biggest expense is fixed. So that's one of the main reasons I love it. I love, multifamily. And to Ryan's point, also the tax benefits. If you were then also just to compare the S&P 500 and multifamily based on that, what they call the tax equivalent yield is even higher on multifamily, because there is no tax equivalent yield to the stock market, right? Because you're not getting tax benefits. Yeah, if you're in a retirement account, sure, you're not getting taxed, but there's no cost segregation. There's no deferred tax bill from depreciation, amongst other things. I'm no CPA, but from our experience, it's been quite beneficial. So those are the main reasons. Plus, I mentioned earlier, it's tangible. I can feel it. I can control it. I can't control what some CEO is going to do today or tomorrow at some equity I own, or I can't control what the government's going to do that's going to affect the industry of the stock I'm invested in. I just can't control that. But I can control my properties, right? I can control how they're operated. I can control the tenants we bring in. We have very strict leasing criteria, right? You got to meet certain rent to income ratio. You have a certain, credit score. I can control all of that. And that's why I love investing in multifamily. Yeah. And it's housing. It's housing, right? At this point, Amazon's the big threat to most industries. They haven't figured out how to do housing yet. So I think we're safe there.
Totally, man. I think one of the reasons why, aside from the fact that we just vibe well, our personalities, and that's why our partnership operates the way it does, but I really respect when you first get into real estate, people are telling you, okay, you need to get a buy box. And that is true. When you're starting out, you should think, I buy 3-bed, 2 baths in this area and I want to churn that way. But as you develop into a more experienced real estate investor as a whole, you realize, okay, there's an opportunity to potentially wholesale this deal or flip this deal. And in the multifamily space, what we're looking at is okay, if I keep my buy box somewhat narrow, and I'm buying right now in the Northeast at 5 to 50 units, I still have the ability to change my structure and change my outcome of this. I can go Section 8 on this property, or I can go midterm rentals in this property. And I think the ability to develop and for you to look at a deal and for us to look at a deal and say, hey guys, this is the way I think our investors will make a return on this. This is the way that I think this deal will actually formulate, not just like I only buy Section 8, so I can't touch this deal, or I only buy midterm rentals, or I only buy a certain thing, so I can't touch this deal. The way we've been able to look at deals, and I give you mainly the credit for this because of the eye that you have for boots on the ground, that to me is what you get when you're in the game long enough. And that was the thing that Rye and I were lacking for years until we created the right partnership. So this is a message for anyone to just find the right partnership so that you can meld the skill sets together so that you can grow this. And now the benefit is that anybody listening to this podcast episode, once we get to know each other, you can invest in deals with us and you can do your job and do what you do best. You go and you make the money in your W-2 job and then you put your money to work with people that have been doing it for, Shawn has been doing it for 13, 14 years, and Ryan and I have been doing it for 7. So that is how this plays out, and that's why I really like our partnership. And
And one thing I'll say, because you just made me think of this, Corey, that I've learned over all those years is to your point of what I say is knowing your market intimately. It makes such a difference. So I went from buying, like I mentioned earlier, buying small to mid multis in southern New Hampshire. And then for a brief period of time, like I mentioned before, everyone loves the Sun Belts. Well, Shawn went to the Sun Belts, so I did that, and so far it's been good. But I will tell you is I don't know those markets as well as I know the ones that we partner on. I just don't, and unless you're a big firm that has a bunch of analysts, I just even to that extent, I still don't think you can know it as well. Like, in my market, I can drive down and I can tell you what 2 beds on this side of town are getting versus 2 beds on that side of town can get. I can tell you what that's going to trade for per door, or what it should at least. I know the debt terms of the market, right, from the local and regional players. I know who owns that building. Like, I have these relationships. I know the contractors I should and should not use. That's why when people say, like the cliche, local, location, right? It's true. And it's not just buying, right? But it's knowing your location. And that is what has made the difference. So we went from, for a short period of time, focusing on the Sun Belt to coming back home. And it's just made the biggest difference. And to Corey's point, we don't have a big buy box, but it's definitely bigger than it was because we just know the market so well. And to his point, we can do like Section 8 here and midterm there. I will say we can do that and do that, but at the same time, we still underwrite as what would happen if that play didn't work and we had to go to our bread and butter, which is long-term rentals. Yep. And it might not be as a killer of a deal, but as long as we're not going to get into trouble, it cash flows, then we do that type of stress test as well. So yeah, it really comes down to knowing your market well, which I know some people out there preach, long-term investing, or not long-term investing, but, out-of-state investing. And sure, you can do good at that, but I don't think you're going to beat the person who's local to that market. There's no way. They're going to run circles around you time after time. That's just a fact.
Yeah, and you learn this after going through the game a little bit and trying different markets. And I think we've just overall, to put a pin in this thing, it's your competitive advantage. And that's our competitive advantage, is like in being able to invest in your backyard and home growing these relationships. There's nothing that can top that, especially if you go with conservative underwriting. But it's also to find the deals and having the opportunity to know immediately when someone's selling and not even have anything hit the market. It's all about relationships in this game. And so overall, I think demographics are on our side too. Or I should say, I know this, like baby boomers are downsizing into rentals. Millennials are delaying home ownership and choosing flexibility, and most are renting. Remote work, if you think about it, since COVID, this has increased due to a lot of different things, but we've seen a lot of people move from Boston to New Hampshire and Vermont. And with supply being constrained and demand only growing, it's just it's a perfect storm for what we're doing, right? And for multifamily investors to diversify outside of the stock market. So that's why we're huge proponents of it and what we wanted to talk about it today. And truly, this is how Corey, myself, and Shawn are building wealth beyond the stock market. It's by owning stable, income-producing, scarce assets, specifically multifamily properties that are in high-demand markets and that appreciate over time. It's that simple. You have to find the deal, you have to underwrite it, but then build a business plan around it and execute it. And as long as you have the right people doing this in the local market that they are boots on the ground and they grew up in, it's a perfect storm. It's amazing. So, I'll just say this, we continuously have deals circulating in the pipeline and we're always hunting for the next project. So if anyone listening, if you're interested in partnering with us on a future deal or would just like to stay up to date on future opportunities, fill out the investor interest form that's located in the show notes. You can also visit our website, juice-enterprises.com for more information. You'll see links to Shawn's website too, Greenbriar Capital. That's greenbriarcg.com. And you can kind of see our business plan and how we run our ship together as a united front. And, this is just the beginning for us. We've had two amazing deals go through, and we are going to continue to buy deal after deal together. And we're targeting for a deal a quarter, right? Sometimes it'll be a couple deals a year, but we're really looking to churn this thing and build out a very strong portfolio together. So if you guys are interested, guys, gals, fill out that form and we'll be happy to have a conversation with you and see if we're the right fit to eventually work together. But Shawn, dude, I just want to say thank you for coming back on the show, man. It's always a pleasure. I know I see you every week, but it is cool for our listeners to get a peek behind the curtain to, see one of our allies, one of our partners, and just kind of how we run our ship. So I appreciate you, brother.
Yeah, I appreciate you guys. Thanks for having me again. Maybe I'll be lucky enough to grace you all again with my presence.
Three would be big, dude. 3 would be big. So we'll hold you to it. Thanks for coming on.
There we go.
Yeah, man. All right. Well, everybody, appreciate you. Thanks for tuning in. We'll see you next week.